In this video, we'll talk about the consolidated balance sheet of a company. The consolidated balance sheet of a company is on a year-on-year basis, meaning the numbers of this year gets carried forwarded to the next year, so on and so forth. Whereas the P&L that we looked at in the previous video talks only about the specific year in consideration. So this is a subtle difference between P&L and the balance sheet, which you need to be aware of. I've got the balance sheet of Bajaj Auto here. I'm continuing on the same example that we spoke about in the previous videos. The balance sheet consists of two broad sections, that's the assets of a company and the liability of the company. Now, both assets and liabilities can be broadly divided into two subcategories each, the non-current assets and the current assets, the non-current liability and the current liability. So in a sense, you have four small divisions within the balance sheet. So let us focus on the asset part of the balance sheet. Non-current assets are assets which have a long-term economic benefit to the company. This can include things like the property, plant and machinery. It can include intangible assets. Intangible assets are things like trademarks and patents that the company holds. It can also include financial investments. These investments are usually long-term in nature. It could be a long-term government bond, for example, long-term investment in mutual funds. So all these things put together form the non-current assets of the company. Now the current assets are also similar in nature, but it's just that these are assets which have an economic output within 1 year's time frame. Some of the examples of current assets are inventories. Inventories is nothing but the finished goods that the company has and is ready to be sold, hopefully over the next 1 year. It can include trade receivables. These are receivables, these are payments that the company is expecting. It could be from vendors or customers within the next 1 year. It can include loans that they've given out and the repayment that they're expecting within the next 1 year, and cash and cash balances held with the bank. Now, as you can see in Bajaj Auto, for the year 2021, the total non-current assets of Bajaj Auto stands at roughly about 19,400 odd crores. The current assets of Bajaj Auto stands at 14,187 crores. So the sum of current and non-current assets will give me the total assets held by Bajaj Auto. In this case, it is 19,400 plus 14,187, giving me 33,601 crores. So when you're looking at the asset side of the balance sheet, please pay attention to some of the largest line items in the asset side. In this case, clearly the financial investments, that is the non-current side, is a large line item. So I would be interested to dig further into this. And how can I do that? I can do that by going to the associated note. The associated note is 5B in this case. So I would go there and dig deeper into what sort of investments that the company has made here, just to understand the nuances of that particular line item. I also see that the property, plant and equipment is also a heavy line item, 1,500 odd crores. So I would go to note number 2 here and spend more time to understand the nature of this particular line item. So the point here is that whenever you find a heavy line item in the balance sheet, you go to the associated note and dig deeper to understand the nuances of that particular line item. Now let us focus on the liabilities part of the balance sheet. Now, as you can see that there is the non-current liability, there is the current liability, just like the way we had the current and non-current assets. But we also have a third part here in the liabilities, which is the equity part. We will talk about the equity part a little later in this video. To begin with, let's understand what a liability is. A liability, simply put, is the obligation, the financial obligation of a company. Think about an individual who's who's taken a personal loan. Now, at some point, the person has to return this loan back to its lender, right? So that's a financial obligation. In the same way, a company too has different financial obligations. All that bunched together is what is reported in the liabilities part of the balance sheet. Non-current liabilities are financial obligations which can be fulfilled over next few years, whereas the current liabilities are financial obligations which has to be fulfilled within 1 year time frame. So to put this in perspective, think about a credit card loan that you've taken which needs to be fulfilled over the next month or two. That would be a current liability for you as an individual. Whereas you've taken a housing loan which you intend to fulfill over next, let's say 5 years or 10 years, that would be a non-current liability on your own personal balance sheet. So let's just take a quick look at some of the line items on the non-current liability side. For instance, in Bajaj Auto, there is a line item which says provisions, and there is also an associated note numbered 16. So you can always go to the associated note to understand the nature of this particular line item. Let me do just that. So note 16 gives me the details of the provisions under non-current liability. And as I can see, it consists of provisions made for welfare schemes, provisions made for compensated absences. It also includes warranties, which I'm guessing are claims on the bikes that they've sold. So all these things put together forms the long-term provisions of Bajaj Auto, which is what is mentioned on the non-current side of the balance sheet. Likewise, you can do the same thing for the current liabilities parts as well. For instance, we've got a line item which says other current liabilities with an associated note number 19. You can always go to that particular note to understand the nature of that particular line item. So let me do just that. So as you can see, other financial liabilities here includes things like security deposits, commissions payable, it includes the employee benefit payables, and it also includes the other payables. All these things bunched together forms the other current liabilities of the balance sheet. So the other section of the liability side of the balance sheet is the equity section. The equity section has two parts to it. One is the share capital of the company. The other one is called the reserves and surpluses. In this case, Bajaj Auto simply calls it the other equity. But if you go to the associated notes, you will see that it's split into reserves and surpluses of the company. In a very simplistic way, think about the share capital as the amount of money that the promoters and the early investors put into the company to start the company. In this case, the share capital happens to be 289 crores. Now, going ahead, if the company raises more money for whatever purposes, then the share capital will actually increase. Other equity, like I mentioned, includes reserves and surpluses. Let's actually go to the notes of other equity to understand the nature of that line item. The associated note is 14. So let me go to note 14 here. Like I mentioned, other equity includes reserves and surpluses. The reserves and surplus of a company is basically profits flowing in from the P&L statement and sitting in the reserves and surplus part. The company earmarks funds for different purposes, and that's what really the reserves and surplus of the company represents. I would encourage you visit Varsity's fundamental analysis module. We've got tons of information there and lots of comments around this topic. Please do read through that, and if you've got any queries, do post a comment and we'll be happy to get back with a response. Key takeaways from this video are: